Hi there, and welcome to today's practical planning tip by ParkBridge Wealth Management. My name is Jonathan Shenkman, and I'm the president and chief investment officer of the firm. So today we're going to continue our series of videos that discuss the basics of investing and financial planning. And yesterday we discussed how the basics of investing can be compared to a birthday cake, which has four main components: the actual cake, the frosting, sprinkles, and cherry on top. And obviously, because of the theme of this discussion, I'm wearing my Davy Crocker hat. Let's first discuss the actual cake. The cornerstone of any birthday cake is the cake itself. There's no debate about this. Without it, you may have an impractical and unappetizing mess of ingredients on top of each other, but it certainly isn't a cake. The analogous essential cake part of every investor's portfolio is a combination of stocks, bonds, and cash. Let's discuss and define each one of these areas of the market or asset classes. First, stocks. Stocks represent an ownership stake in a company. For example, Coca-Cola is a large company that issues stocks. If a member of the public buys one of those stocks, they own a piece of the Coca-Cola Corporation. If Coke is up in value, the stockholders will make money by owning a share of a more valuable company. They can sell their stock for a higher price than they actually paid for it to buy it. Conversely, if it goes down, they will lose money. Additionally, Coke offers a dividend, which is a cash distribution to stockholders. That means stockholders are actually paid part of the profits for owning the company while they wait for it to go up in value. Technically, stocks have unlimited upside. That's why they may be the best vehicle for long-term investors who need their money to outpace inflation. However, stocks can also go bankrupt or remain stagnant for a decade or more. This is why stocks are risky and investors need to be prudent when choosing what stocks to own. Next is bonds. Bonds are a loan made by an investor to a borrower. The borrower is usually a company or a government entity. Bonds are used by companies, municipalities, and states to finance projects and operations. Investors that own bonds typically receive the principal of their loan at a specified maturity date. In addition, over the course of the holding period, the investors receive interest payments to compensate them for lending out their money. Bonds come in many shapes and sizes. Some are very conservative, like treasury bonds issued by the U.S. government. Other bonds are riskier with a higher potential for default, like those issued by companies that are not in a strong place financially. Typically, the bond portion of an investor's portfolio is considered more conservative and serves as a ballast for the more volatile stock portion of their portfolio. Bond returns typically don't outpace the rate of inflation over the long term. Therefore, consistently maintaining too much bond exposure may cause an investor to lose buying power and limit their nest egg's growth potential. And finally, let's discuss cash. Cash is the least exciting investment and usually has the lowest return since it carries the least amount of risk. However, cash plays a key role in any investor's portfolio and is particularly crucial for retirees. As folks are approaching retirement, having a cash cushion, possibly 2 to 3 years worth of expense money, can help mitigate the risk of market plummeting right before someone needs their money. In such an unfortunate scenario, retirees can withdraw cash without needing to liquidate their investments that have plummeted in value. This cash cushion early in retirement is crucial to helping ensure that investors don't outlive their money. Once investors understand the basic stock, bond, and cash concepts, the key is deciding what percentage of their investments should be allocated to each asset class, and that is determined based on their time horizon and risk tolerance. Tomorrow, we're going to discuss the frosting portion of the investment cake. And with that, I hope you found these practical planning tips helpful. Until next time, stay prudent, practical, and don't forget to plan ahead.